CNBC-TV18, embarking on a quarter century of excellence.
Hello and welcome to Startup Street. I'm Shruti Mishra, and with me as always is Arundhati Ramanan. These are the top headlines from the startup space. Digital banking infrastructure company M2P Fintech acquires transaction behavioral intelligence company Goals 101. CNBC-TV18 learns that the deal size is 250 crore rupees and it is a 100% acquisition.
Kunal Shah-backed digital banking platform Q acquires Kiwi Money, a lending platform for the healthcare industry, for an undisclosed amount. The move will help Q expand its operations in India.
Micro-lending platform iFinance raises 310 crore rupees in its Series F funding round led by British International Investment. This round saw participation of Waterfield Fund and existing backer A91 Partners. Funding round comes after a hiatus of over 3 years for the company.
V-Grow, a B2B fruits marketplace, raises $46 million in a Series C funding round led by Singapore's sovereign wealth fund GIC. Round also saw participation from existing investors Process Ventures, Matrix Partner India, Elevation Capital and Lightspeed.
Fast fashion brand Snitch raises 110 crore rupees in a Series A round co-led by Singapore's SWC Global and Ivy Cap Ventures. Snitch will use the money to expand its offline footprint, hire more people and better its tech capabilities.
Google, Meta, Qualcomm and 7 other tech companies have teamed up to push for open digital ecosystems in response to new EU tech rules. Calling itself the Coalition for Open Digital Ecosystems, the group said it wants to promote more open platforms and systems to boost growth and innovation in Europe.
Social media platform X's 2023 ad sales are projected to fall to about $2.5 billion, Bloomberg reported. Several companies, including Comcast and Walt Disney, paused their advertisements on the platform. Joe Benaroch, head of business operations at X, told Reuters, the report presents an incomplete view of our entire business.
Those were the headlines that we're tracking for you this evening. But on what's brewing today, micro-enterprise lending firm iFinance has secured 310 crore rupees in its Series F funding round. The round was led by UK's development finance institution British International Investment, with participation of Waterfield Fund and existing backer A91 Partners. I has so far raised 1,000 crore rupees of equity. How does the firm plan to use the funds? We discussed that and more with Sanjay Sharma, the MD and CEO of iFinance. Sanjay, thank you so much for joining us on Startup Street today. You know, like I just said, you've raised about 310 crore rupees. After almost 3 years, this fundraise comes. So why now? What do you plan to do with these funds? And also, how much are you valued at post this round?
First of all, we are super excited that we have raised a fairly large amount of money. And in this times in the market, this is truly a good deal to have. The money is needed now by iFinance because we've been growing rapidly. Last year, we grew our book by over 55%. We again are going to replicate that effort this year. And we have seen some tremendous growth in the first 6 months. So this money will go towards expanding our business. It will go towards opening some more branches. We'll be opening 80 new branches. We already have 395 branches. So it will substantially increase our ability to source business in the market. So it's come at a good time. And as I said, that we got a good valuation. While I cannot share the exact detail, but we have diluted roughly 12% for this raise. And most of it has gone to BII, which is a new investor besides the existing investors who have also invested.
All right, so you've diluted about 12% of your stake. Now, in fact, the last time I spoke to you was when you all had announced your results and you saw 55% growth. You're hoping to do the same this time as well. But you had also turned a profit after a short stint in the red. So talk to us about where your revenues are at now, and are you on track to retain profitability?
Oh, absolutely. While during the COVID years, we did take a decision to clean up our books, and we took a loss in that COVID year. But last 2 years, including this year, we've been doing well. We turned in a profit of about 40 crores last year. And this year, in the first half of the year, we have turned a profit of 80 crores. So clearly, we are seeing a complete change in the dynamics of the business, primarily from the cost efficiencies. Delinquencies are back to normal the way they used to be prior to COVID. So I think this is all getting factored into the large pack. We're very happy to say that we have started delivering a return on equity of almost 19.5%, which is a good benchmark to have.
Lots of good numbers there, but also give us a sense of your AUMs, your loan book and NPAs. Where are they at right now? And how have you managed to reduce your operating costs?
Yeah, I think our AUM today stands at 3,600 and we will end this year hopefully at something in the range of 4,200 crores. And that is based on the estimate of growth that I mentioned. We are well on target for that number. I think the reason for the fall in our cost of operation is one is that the volume has increased, the top line is bigger, but also many automation related initiatives that were taken last year and this year are bearing fruit. The productivity of loan officers has gone up, the productivity of our back office has gone up. So it's sheer hard work on various processes to bring efficiency.
But, iFinance is also mulling entering the public markets in FY26. So are those plans on track as well?
Yes, I think FY26 is 2 years away, so still far off. But we will start preparing for that. I think we are in an excellent space in terms of our size and in terms of our profitability to go for an IPO. So I think we would probably look at FY26. Where we will plan. Again, in 2 years, many things will happen, and our ultimate plan will depend on how things are more closer to FY26.
All right, absolutely. So right now, FY26 looking like a good timeline. You want to continue to penetrate further into the MSME lending space. So what is attractive to you about the space, and where do you see this market going for you in terms of growth?
Yeah, I think MSME market itself is a very attractive market, and within that, the micro enterprise where we focus on is an extremely interesting and attractive market. We are the largest lender in this space, and I think we have understood this space well enough in the last 9 years to not only make our processes efficient, make our methods of origination efficient, but use a lot of data science and machine learning models to improve our ability to collect from the customers that we have lent to. There are many such things that go towards creating the efficiency in the organization. So I think we find this a very attractive space. There's still a long way to go in terms of penetrating the market. We have given loans to date to almost 800,000 borrowers. And this segment, the estimate is that it is as big as some 67 million such enterprises. So
right.
Long way to go and many miles to cover.
Right, so a long way to go, many miles to cover, and a big opportunity there. All right, Sanjay, thank you so much for joining us on the show today, and we wish you all the best going forward.
Thank you for having me on the show, and have a good night.
All right, moving on. E-retail in India has experienced strong growth with an estimated value of $57 to $60 billion in 2023 and is now expected to scale beyond $160 billion in value by 2028. Now, this represents an annual addition of $8 to $12 billion since 2020. In fact, with online spending, which is currently only 5 to 6% of total retail spending in India versus 23 to 24% in the US and over 35% in China, the Indian e-retail market clearly has a massive headroom for growth. Now, these findings stem from the 4th edition of How India Shops Online, a report released by Bain Co in collaboration with Flipkart. And to take us through the key findings, joining me now is Manan Bhasin, partner at Bain Co. Manan, welcome to Startup Street. You know, in India, around 240 million shoppers would have bought something online in 2023. Adding to this, there remains significant headroom to grow, given that over 60% internet users in India are not yet shopping online. So what has been, and what will be the biggest game changer for the industry?
Thank you. So e-tail really has been a disruptive force in India's retail market. We expect this to continue growing at 25% over the next years. Typically, we've observed 3 trigger points which unlock e-retail penetration in any country. These tend to be digital access via affordable data, physical access in terms of wide reach and low-cost logistics, and the emergence of digital ecosystems. We've seen all of these play out in India in a material way over the last years. To give you an example, data prices have crashed 95% since 2015. The one trigger point that has not yet been fully realized is affluence. We typically see a material uptick in the spending per shopper once the GDP per capita for a country reaches about $4,000. India is straggling at about $2,500 right now.
Okay.
And as soon as this unlock is met over the next few years, we expect about 65 million households to come into the upper middle income brackets. And this is going to unlock a humongous amount of discretionary spending.
Absolutely. Manan, let's now talk about the business side. The merchant or seller ecosystem has also grown leaps and bounds, with twice as many sellers added last year compared to the previous years. And a majority of these new sellers come from 2+ cities, tier 2+ cities. If you could talk to us about the dichotomy, buyers in top cities and sellers in small towns.
Look, there continues to be a myth that India's e-commerce is predominantly in top cities, right? So 7 in 10 shoppers today reside in tier 2 cities. What we find is an increasing number of these shoppers are actually coming from tier 3 cities. Tier 2 consumers have always had the affluence. They've always had the aspiration. The missing link has always been access. E-commerce bridges that. The seller ecosystem has grown leaps and bounds. One of the big things, in my opinion, is the logistics infrastructure, which has been developed both by e-commerce companies as well as the third-party logistics companies, right? This has been a great equalizer. Now you can very much imagine a seller producing something in Tirupur and then a consumer getting it in Mumbai the very next day. So in some senses, this dichotomy is overstated, because the real advantage and beauty of e-commerce is the fact that it can actually normalize and equalize this.
Sure. Okay, let's now talk about the new business models that will emerge from this great e-commerce churn. There is Q-commerce, we've got live commerce, and there are other models that we've seen companies experiment with. So what happens next? Will AI be the game changer?
So look, 4 key business models, in my opinion, to keep an eye on. Quick commerce, fast fashion. You spoke about Snitch a little while earlier on this program. Inspiration-led commerce and hyper-value commerce. Now, each of these are at varying levels of maturity in India. Quick commerce, for example, is really beginning to find its feet, with 40 to 50% of overall e-grocery spend coming from quick commerce. On the other hand, something like inspiration-led commerce is still at very nascent stages. I'm glad you asked me about generative AI, because we are very, very bullish and very excited about the potential of generative AI. A series of high-impact use cases will emerge, which will help both consumers as well as sellers, as well as e-commerce companies. I'll give you one example, and Flipkart has really been the torchbearer of this in the Indian context by introducing live or conversational commerce via shopping assistants.
Yes.
Imagine I wanted to buy this jacket, and I can actually interact with somebody on the platform, which can give me very customized and tailored advice based on my shopping preferences and what I would like and my unique needs. This is just some of the nascent use cases, in my opinion, right? There's a ton that's happening around cataloging, around ad copywriting, etc. And the use cases will really mature over the many years to come.
Yes, Manan, but what about the money? What's the profitability roadmap? Where is the most promise? And, as this is a high cash burn sector.
Look, focus on profitability has been immense across e-commerce companies and more broadly across India internet, right? Like many of the marquee global companies that you think about, Pinduoduo in China, Shopee in Southeast Asia, Coupang in South Korea, all of these have turned EBITDA profitable over the last 2 years. And beyond kind of the scale benefits that you get on the gross margin line, e-tailers are also using 5 or 6 big monetization levers. Ad monetization is a big one, seller services, another big one, fintech, logistics and other externalization, and subscription services.
All right. Manan, very quickly, if you could answer my final question. We've been talking money. Retail media is the third big wave in digital after search and social across geographies, but retail media spends are only 15 to 20% of digital ad expenditure in India, compared to 25 or 30% in the US and almost 60% in China. So how does this pie grow, if you could answer that quickly?
Look, ad tech is more developed as far as monetization levers go in India. That said, there is the underlying digital ad dollars will itself go up, in my opinion. Today, the digital ad share as a percentage of the overall ad dollars in India is still significantly lower versus India. That's 30 to 35% versus 65% in the US. Simultaneously, what you'll see, e-retail itself on the spend or ad spend will increase because the coverage of brands and sellers will grow, and simultaneously there are certain categories which will push more, or brand, for example, fashion, etc., will push even more, and that will grow the pie further.
Got it, Mana. Unfortunately, we've got no more time left, but many thanks for joining us on Startup Street and for taking us through the key findings of the report.
Thank you. My pleasure.
On that note, it's time for us to head into a short break. But coming up, Singularity Growth, an operator investor-led growth equity platform, appoints Mithun Sacheti as its co-sponsor and general partner. A special conversation on the other side.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back to Startup Street. In a significant move within the private growth equity ecosystem, Singularity Growth, an operator investor-led growth equity platform, has appointed Mithun Sacheti as its co-sponsor and general partner. Now, Mithun was an entrepreneur who founded Carrot Lane and sold his remaining stake to Titan for over 4,600 crore rupees. Speaking to Shireen Bhan, he said that the investing has always been something that he enjoys. And Yash Kela said that they've completed their first fund and are now looking at their second fund. Here's a slice of that conversation. Listen in.
Investing was something that I've always enjoyed, and I look forward to partnering with Yash and take this forward. My whole journey, I always felt that investing requires an operator as a part of this partnership as well. And I thought that this investor-operator relationship is something that will help us sort of work with Indian businesses differently.
Yash, congratulations on bringing Mithun on board. And let's talk a little bit about what this is going to bring to the mix as far as Singularity's growth trajectory is concerned, your investment plans from here on.
We have executed Fund 1 with the guidance of everyone around us. And now Fund 2 will be a larger scale up around Fund 1, which was core, which is participating in companies which are at that cusp of growth in capital efficient categories. These are companies which are typically between 200 to 800 crores of revenue, and at steady state can generate 30-40% ROCEs. Each pool of capital for us has about 14 to 18 investments. This will be the case, but this corpus is larger. So our check sizes will become larger in the deals that we incrementally participate.
I used to get... If 2022 was all about the fears of the funding winter setting in, this year has been about the survival of the fittest. Listed new age tech companies have hunkered down and demonstrated a turnaround in profitability. So have several unicorns, but deal making remains slow, even though over $20 billion worth of India-dedicated dry powder is now ripe for investment. As we turn the page on 2023, Akhil Vishwanath joins in with a lowdown on where the dollars are and what more will it take to bring investors back. Take a look.
If winter is coming was the familiar refrain in the Indian startup ecosystem in 2022, then 2023 was all about the long wait for spring. As predicted, the venture capital pipeline did freeze over, and as you can see, funding slumped to a 5-year low in 2023. Now, what's interesting is, while founders were facing icy winds, investors were ready to warm up their coffers after record investments in 2021. As a result, what we have seen over the last 2 years is perhaps the largest accumulation of dry powder, a record $20 billion worth of fresh India-dedicated funds and another $40 billion that global private equity and venture capital investors are likely to allocate to Indian startups. Now, the global investment outlay, as you can see, stands at a whopping $500 billion. Now, as we assess these numbers, what we have to remember is this. While these announcements for new funds have been made, a large majority are yet to be closed. Now, if we take a closer look at the large global fundraisers with an India play, on the list are some of India's top unicorn builders. Now, of these, Atlantic, General Catalyst and B Capital, all of them plan to invest at least 20 to 25% of their funds in Indian startups over the next 2 to 3 years. Now, among those that have announced purely India-focused funds, Peak 15 Partners, which was formerly Sequoia Capital India, has the biggest war chest, about $2 billion. For each of the VCs on this list, these are the largest ever India-dedicated fundraisers. It's a long list and includes the likes of Matrix Partners and Lightspeed, among others. Now, over the last 2 years, several homegrown VCs have also seen their funds grow in size and scale. Bloom and Fireside are good examples. This year, we have also seen many more announce their largest funds till date. While 314 Capital, Arkham Ventures and IAN have a laser focus on backing early-stage startups, Shirate and Epic Capital plan on investing in growth and late-stage startups. In fact, Shirate launched its maiden growth fund this year. Now, if you move further down the venture investing funnel in India, there are over 100 active micro-VC funds, each with an average fund size of more than $20 million. Now, these investors enter early, mostly at the seed stage, with a futuristic investment thesis. Now, these are, of course, clear signs that India's domestic venture capital ecosystem is evolving and maturing. But given the global macroeconomic situation and the high interest rate regime, fundraising has been as tough for younger micro VCs as it has been for startups. But the Dry powder, nevertheless, is still large, the largest ever pool of domestic and foreign money available for Indian startups. But the deal-making has slowed to a 5-year low and investors aren't loosening their purse strings yet. Why? Rahul Chaudhary of Stellaris Venture Partners says that there is excessive dry powder in early stage, but not enough founders are starting up. Webb of Domkundwar of Better Capital concurred and said the period is similar to what he saw for a few years after the dot-com bust in the early 2000s. The coming of generative AI this year is also likely to have sent several founders back to the drawing board. When it comes to growth stage startups, 2023 was all about transitioning from the growth at all cost strategy to profitability. Rajan Anandan of Peak 15 Partners says growth stage investing remains slow. Investors are focused on high quality, sustainable companies. The correction that it has brought about has certainly reset expectations of founders, says Nitin Kamath of Zerodha. And he says that that's a good thing. Valuation will have to correct further, losses will have to come down, and more unicorns will have to head to Dalal Street and find a way to offer exits to investors. Why? All that for confidence to return to Startup Street.
Thank you, Akhil, for giving us a lowdown of the startup funding picture this year and the dry powder math. With that, it's a wrap from Arundhati and me, Shruti, on this edition of Startup Street. Stay tuned to CNBC-TV18 for more news and updates.
CNBC-TV18, embarking on a quarter century of excellence.